Hi, today we're going to dive deep into determining your company's long-term goal. Now, have you even thought about the long-term goal for your company? I'm not talking about making a profit here. We know that every company's goal is to make a profit. What I'm asking you is to dive a little bit deeper than that. I'm asking you to think about the exit strategy for your company's end goal. Do you plan on leaving your company to your kids, or do you plan on selling your company in the end? And if you are planning on leaving your company to your kids, do you want to leave them an unhealthy company? And who's willing to purchase an unhealthy company? Now, let me ask you this. How do you know if your company is healthy or just like my home and community service agency owners care for their patients, it's important for you to diagnose and nurture the finances of your company. And one statement that a lot of companies look at to determine how healthy their company is the profit and loss statement. But let me let you in on something. The profit and loss statement is not the only statement to look at to determine your company's wealth and health. There are three different statements that are out there that you should look at on a regular basis. It is your profit and loss statement, also your statement of cash flow. But we also want to look at your balance sheet statement. The balance sheet statement is a very important statement that helps you determine how healthy your business is. So I don't want you to just look at this profit and loss statement or even your bank statement. A lot of companies look at the bank statement and they go look at this chart that the bank statement provides for them, and they determine how healthy the business is or how good the business is performing based off of this chart. Please do not make important business decisions based off of this chart. My name is Shaylis Watkins, and I'm a financial strategist that specializes in helping home and community service agency owners increase revenue and monthly cash flow by 25% with organized accounting and monthly bookkeeping strategies. Now, let me take you into my world and show you the components of a balance sheet and how it can help you determine whether your business is healthy or unhealthy. Okay, so here we are. Yes, in my world, QuickBooks. What I have opened here is a sample company. And where I want to go, what I want to show you is the actual balance sheet report. So we're going to go to reports and we're going to click balance sheet. Right here is the balance sheet. What I want to do, I'm going to go ahead and just set it up for last year's information. And right here we have cash and we have accrual. It's best to use accrual. Well, I would recommend using accrual method because it tells you more about your company, how your company is actually performing in real time. And I click hit run the report. Okay, so we're going to take you back to the basics of accounting, where you learned assets minus liability equals owner's equity. So let's go through the components of the balance sheet one by one, just so we can get an idea of what each component consists of and what it means. So first, we're going to take a look at the assets. Now, the assets is what your company owns. This is where you will see your bank statements, which is your cash. Also, your accounts receivable. Now, your accounts receivable is an asset account. It is services that you've provided, but you have not yet received the funds for it, but you do plan on receiving those funds within a short period of time. So we put that here when you're doing the accrual method because we want to take into account the services that we have provided and the funds that we will be receiving for that service. Next, I will take you to, we also have undeposited funds here, and that goes with accounts receivable. They work together because if you haven't put any funds, like you receive funds, you've provided a service, but you have not placed it in the bank yet, then it will go into undeposited funds. So once you place your funds in the bank, then it will decrease or remove the funds from the undeposited funds. And so this component consists of your total assets. Now, some of the things that are not showing up here that I would like to make a note of to you is your depreciable assets. So we're talking about your homes. If you're in the home and healthcare business, a lot of times you purchase homes for your community service stations, and your homes will show up here in your assets. That will be known as your fixed assets. And so those items are not showing up here, but those are things that you need to take account of. And this is the one part that does not show up in your profit and loss statement, in your income statement. So that's why I wanted to show you how important the balance sheet is. The profit and loss statement does not show your bank statements. It doesn't show your bank account. And so to get an idea of what's actually in your bank, your cash, your fixed assets, the things that you own, it's good to look at your assets. Then we move to the liability section. Liabilities are things that you owe. So if you have a loan, if you have a credit card out, those things will show up in your liability section. So let's say, for instance, you received a small business loan. That loan is going to show up here in your liability section, and it is money that you owe. So it will take away from your assets. So that is part of the assets minus liability component. And then we know that assets minus liability equals your owner's equity. Now, this is the part that shows you how healthy your company really is. You will see that it includes your net income or either your net loss. And remember, I mentioned that it's good to look at the three different statements. Don't ignore your profit and loss statement. You still should take into account your profit and loss statement when you are diagnosing how healthy your company really is. And that is because that net income or that net loss from your profit and loss statement will come up into your balance sheet, and it will show up in your equity section on your balance sheet. And in your equity section, it also includes your owners. If you are a partnership, you it's best to allocate the cost between the owners. Like you can have an owner one and an owner two and the percentages that they own of the business. And you can also include what they are contributing to the business and what they are actually distributing from the business. And one thing is that we need to make clear is that if you are a sole proprietor and or if you're a LLC, that means if you're not an S corp and if you're not a corporation and you're an owner, then you're taking owner's distribution when you pay yourself. And that's one reason why we ask company owners, business owners to not commingle funds. Is because when you commingle your funds, you're really jeopardizing knowing how your company is actually running. For instance, if you everything that you take out of your company, like you're using your bank statement here, you're using your bank account to go purchase personal items. That is coming out of your owner's equity, and it's not going to give you a clear picture of how your company is actually running. So, this is just a quick overview on how to determine how healthy your company is. and how important the balance sheet is to determine your company's health. I hope this information was helpful. If you have any more questions, you can click the link to my calendar and we can hop on a 15-minute strategy call. Wishing you much success in your business. Thank you.